Hi everyone, Kirk here with Tactical Options Trading. Thank you so much for joining me here on this video. So today I wanted to take a look at understanding profit and loss diagrams when trading options. So when we trade options, it's very helpful to understand where we're making money and where we're losing money, and these diagrams really help us out to understand where that happens. So if we look at a profit and loss diagram, you can see our profit and loss line here on this side. Anything above this line would be a profit, and anything below that line would be a loss. And of course on this line here would be our stock price. So when we're buying an option or we're long an option, basically all that means is that we had a debit that was taken out of our account. So when we're looking at where we're breaking even on this trade, we want to find out how much we paid for that option and what strike price that we purchased. So let's say for example we purchased the $50 strike and we paid $2 to buy that $50 strike. Now the stock would have to rise $2 in order for us to make that money back, so we'd add that $50 plus the $2, which would give us a break-even price of $52. So here's that $50 strike, and then we'd paid that $2, and so we're already down on this trade $200 because of that $2 debit that we paid. So we'd need that stock to rise $2 until it hit our break-even point, and anything after that point would be profit at expiration. And now you can see on a long call we have unlimited upside profit potential on this trade. Now let's take a look at a short call position, and we can see how that differs versus a long call. So in a short call position, we received a credit for that trade. So anytime we're short, that means we received a credit for that trade and we received money. So let's say in this example we received a credit of $3. So let's say again that we sold this time, we sold the $50 strike and we received a credit of $3 for that trade. So when we're looking at the break-even point on this trade, we would need our break-even point would be $50 plus that $3, so our break-even point would be $53. So when we're selling a call position, we want that stock to stay below our $50 strike or below our strike price that we sold. So in this case, you can see that arrow pointing down. We want that stock to stay below our 50 strike, and by doing so, and if it does by expiration, we're gonna be able to hold on to that $3 in credit that we received. Now again, that break-even point is just that $50 strike plus the $3 that we received in credit, and that would be our $53 break-even price. Now you can see on a short call, something to be careful of on this on a short call is that there's unlimited risk to that upside. So you can see there's no cap there, that if this stock was to pass our $50 strike, and once we pass that $53 break-even point, at that point, if that stock continued to rise, we would continue to lose money, and ultimately the stock can rise to an unlimited amount, so we have unlimited risk to that upside. So that's something to be really careful for when we're talking about short calls. By the way, if you're enjoying this video, please consider subscribing. All right, let's take a look at a long put now. So when we're looking at a long put, we're basically looking for that stock to trade down, and you can see the arrow pointing down there. So again, we are long of this position, so that means we had a debit taken out of our account. So let's say we bought this position for $2, and let's say this time we bought that $30 put, and we're hoping for that stock to trade down. So in this situation, to find our break-even point, we are going to take that $30 put, and we paid $2 for that put, so we would actually, in this case, we would minus our $2, which would give us a break-even point of $28 on this trade. So the stock would have to move down, in this case, $2 down to that $28 mark, and $28 strike, in order for us to break even on this trade. Now on a long put, we're limited by the stock going to zero, so that's where our max profit would be, as if this stock were to go down to zero. But on the loss side, our max loss would be capped at the $2 that we paid as a debit for this trade. So we couldn't lose anything more than that $2 or $200 on this long put trade. All right, let's take a look now at a short put. So again, on a short position, we are receiving a credit for this trade, and you can see that here. So let's say we received a credit of $3 on this trade, and now we want that stock to stay above our short strike. In this case, let's say our short strike was $40. Now again, to find that break-even point on a short put, all we'd need to do is take that $40 strike, and on this one we received a credit of $3. So, but in this case, being on the put side, we had $40 and then we'd minus that $3, which would allow us to take our trade down to $37 would be our break-even point on this trade. So this would be on the put side, everything's reversed. We got to do a minus on it. So we take that $40 minus the $3 that we received in credit, and that would allow our break-even point to be down here at the 37. And now again, on the short put, the maximum credit that we could receive, or our maximum profit, would be the $3. But the maximum loss in this trade would be the stock going to zero. So whatever that strike price is that you sold all the way down to zero would be your maximum loss in this case, and it would be only capped by the stock going to zero. So now let's take a look at a bullish call debit spread. I know some of these terms get a little bit long, but by looking at the name here, it'll tell you where we're trading this at. So this is going to be a bullish play, so we're looking for that stock to go up. It's going to be the call side of the options chain, and this is going to be a debit. So this is going to be a debit coming out of our account. So in a bullish call debit spread, we're looking to buy a call option and simultaneously sell a higher strike call option. So maybe one of the reasons you would want to do a bullish call debit spread is that the call option that you wanted to initially purchase was a pretty expensive call option. So you wanted to sell a higher call option, possibly out of the money, to offset some of that cost and receive a credit for that. So in this case, we're going to be buying a long call, and then we're going to be selling a call position at a higher point. So let's say that difference was $5. So we had a $5 wide strike, $5 wide spread, I'm sorry. So to find the break-even point on this one, because it's a debit spread, our break-even point would be, now let's say, we have to know what our strikes are here. So let's say this was the $30 strike and this was the $35 strike. So our break-even point would be the 30 plus the debit that we paid. And let's say maybe we paid $2 debit in this case. So it'd be $30 plus the $2 debit that was paid for this. Our break-even point would be $32. So this stock would have to climb in value to 32 before we started making money on this trade. Now on a debit spread, on a spread, we're capped on the upside of our potential. So that, you remember, on just a regular call option, we had the opportunity to have unlimited upside potential. But in this case, since we sold a higher call option, that is capping our profit to that upside, because as that call moves up, this short call position is losing money. So they counteract each other, and it caps our profit at that strike price. So in this case, if this was a $5 wide spread and we paid $2, the maximum that we could receive for this trade would be a $3 profit on this trade, because of that upside cap there on that short call that we sold. All right, let's take a look now at a bullish put credit spread. So when we're looking at a bullish put credit spread, again, this is a bullish play. This is going to be on the put side of the options chain, and we're going to be receiving a credit for this trade. So in this strategy, you're going to be selling a put option, and simultaneously we'll be buying a lower strike put option. Now the reason we'd want to buy that lower strike price would be to protect us on that downside. So when we're selling this put credit spread, we'd be receiving a credit for this trade. Let's say we sold this spread for $3, and so at expiration, we'd want that stock to be trading above our short strike in order to keep that $3 credit that we received. So let's say we sold a $5 wide spread, and maybe this was a $50 strike price here, and we also bought the $45 as protection. So to find that break-even point, we would take that $500 or $5 wide spread minus the $3, and that would allow that stock to trade down to about that $47 mark, and that would be our break-even point on this trade. So we'd want that stock to stay above $47, and that way we would be breaking even on that. But to keep that full $3 or that $300 on our put credit spread, we'd want it to stay above our short strike of 50 in this case. Now on a bullish put credit spread, our losses are capped by that long put strike that we bought down here at that $45 strike. So when we hit that $45 strike, that put strike is actually starting to make money to protect us of the loss of the short strike up here. So it caps our losses by doing that. So what would our losses be in this case? Well, it'd be the $5 wide spread minus the $3 that we received in credit. So it'd be a $200 loss in this case if it were to trade down past that $45 strike. All right, let's take a look now at a bearish put debit spread. So on a bearish put debit spread, again, this is going to be a bearish play, but it's going to be on the put side and it's going to be a debit. So a bearish put debit spread. So in this one, we're going to be buying a put option, and simultaneously we're going to sell a lower strike put option. Again, this kind of goes back to that call debit spread that we were talking about. Maybe that put option is pretty expensive, so you wanted to offset it by selling a lower strike put in this case. And so you could see that here's our debit by buying our long call here, but then we'd be selling a lower strike put in order to bring in some credit for that trade. So we'd want this stock to trade down. We're doing it on the put side, and our losses are going to be capped by this credit that we received to that downside. So if this stock were to go up against us here and start moving the wrong way, we have this credit that we received down here that's going to cap that loss. All right, let's take a look now at what do we got up next. We're going to look at a bearish call credit spread. So on a bearish call credit spread, this is going to be a bearish call. It's going to be on the call side, and we're going to receive a credit for this. So we're going to sell a call option, and we're going to simultaneously buy a higher strike call option. So in this case, we're going to sell the lower strike, and we're going to buy the higher strike for protection. So again, we're going to be capped on that upside by buying that long call, so that if we do start trading up, that we'll have that long call that's going to be protecting us. But as we trade down, let's say we took in a $3 credit for this trade, as long as our stock stays below this strike by expiration, we're going to be able to keep that $300 or that $3 credit that we received when we initially made that trade. All right, now let's take a look at an Iron Condor. So this is going to be a little bit of a challenge, guys. We're putting two credit spreads together to form a short Iron Condor, and I want to show you what that looks like here on the chart. So short Iron Condor, basically we're selling a put credit spread, and we're simultaneously selling a call credit spread. Now we'd use this short Iron Condor if we're looking for this to be a range bound trade, and let's say we sold the $40 put and we sold the $50 call, and what we'd want that stock to do is to be somewhere between those two short positions at expiration. So if we were right down the middle there and we received a $2 credit for this trade, we would receive that full amount of credit if it was anywhere between that $40 and $50 strike at expiration. So You can see here that we have our break-even points on each side. So as long as that stock's above this zero line somewhere before expiration, we're still going to be making money on those trades. But to make our max profit on this trade, we'd want to be between that $40 and $50 strike there. Hey everyone, thank you for joining me again on this video. I hope you enjoyed it. If you liked it, please give me a like or a thumbs up. Consider subscribing. We'll catch you next time.